So you want to own a five-star restaurant, hire a celebrated chef, fill the dining room with candlelight and white tablecloths, and charge $200 a plate. Simple, right? On paper, it looks like the ultimate luxury business. Wealthy guests, premium pricing. A menu where a single steak costs more than most people spend on groceries in a week. It feels like a business built entirely around markup, where every dish practically prints money the moment it leaves the kitchen. But that's only the beginning. The real story starts after that. That's where the economics become interesting. Here's what most people completely miss. Fine dining restaurants, the kind with tasting menus, sommeliers, and Michelin stars hanging over the door, often operate on some of the thinnest profit margins in the entire restaurant industry. According to the National Restaurant Association, the average restaurant nets somewhere between 3 and 6% profit in a good year. Five-star establishments frequently sit at the lower end of that range, not the higher one. That sounds impossible. A $200 steak dinner, barely profitable? Until you see the costs, it doesn't make sense. Once you do, it makes perfect sense. Start with what the business actually sells. A five-star restaurant isn't selling food. It's selling an experience engineered down to the smallest detail. The weight of the silverware, the specific temperature of the dining room, the exact number of seconds between courses, the way a server refills a water glass without ever being asked. Guests aren't paying $200 for chicken and rice. They're paying for theater, ritual, and status, wrapped around a plate of food. This is exactly why people assume the business is wildly profitable. The markup on individual dishes can look enormous. A plate of pasta that costs $4 in raw ingredients might sell for $38 on the menu. A bottle of wine bought wholesale for $20 might sell for $90. Looked at item by item, the math seems obvious. But here's what most people completely miss. That markup isn't profit. It's the raw material paying for everything else standing behind it, and in a five-star restaurant, everything else is enormous. Start with labor. Fine dining requires an army most casual restaurants never need. A tasting menu restaurant with 40 seats might employ a head chef, several sous chefs, a pastry chef, a dedicated saucier, line cooks, a sommelier, a maitre d', a small army of servers trained for years, a dishwashing crew, and back-office staff for reservations and events. Labor costs at high-end restaurants routinely consume 30 to 35% of revenue, according to industry benchmarks tracked by Toast and other restaurant point-of-sale companies. Some ultra-premium establishments push even higher because guest-to-staff ratios at the top end are deliberately kept low. A restaurant proud of white-glove service might employ nearly one staff member for every 2 or 3 guests seated on a given night. Then there's food cost itself, which behaves differently at the top of the market. Ingredients at this level aren't just expensive. They're specific. A five-star kitchen isn't buying generic beef. It's often sourcing Wagyu, dry-aged for weeks in temperature-controlled rooms that cost thousands of dollars a month to run. It isn't buying regular fish. It's flying in fresh product from specific regions, sometimes literally overnight from auctions in Japan or coastal ports in Europe. Food cost at fine dining restaurants typically runs between 28 and 35% of menu price, similar to casual restaurants in percentage terms, but on a menu price 5 to 10 times higher, meaning the dollar amount spent per dish is dramatically larger. That sounds profitable. Until you see the costs stacking on top of each other. Rent is the next brutal line item. Five-star restaurants are almost always located in premium real estate, city centers, luxury hotels, or exclusive neighborhoods where foot traffic and prestige matter as much as square footage. Commercial rent in these locations can run into hundreds of thousands of dollars a year, sometimes structured as a percentage of revenue on top of a base rate, particularly for restaurants operating inside luxury hotels. This is where almost everyone gets it wrong. They imagine a packed dining room every night, tables turning over multiple times, cash flowing endlessly. In reality, fine dining restaurants typically only manage 1 seating per table per night. Sometimes 2 if they're lucky, compared to casual restaurants that might turn a table 3 or 4 times in an evening. Fewer turns mean less total revenue per square foot, even at drastically higher prices per meal. And this changes everything, because it means the entire business model depends on extremely tight execution with almost no room for waste. Consider the real financial anatomy of a night at a 5-star restaurant. A restaurant with 40 seats, 1 seating a night, an average check of $250 per guest, including wine, might generate $10,000 in revenue on a strong evening. Subtract food cost around 30%, $3,000. Subtract labor around 33%, $3,300. That's already 63% of revenue gone before rent, utilities, linens, breakage, insurance, marketing, and administrative costs are even considered. By the time everything is accounted for, the restaurant might be left with a genuine profit margin in the single digits on a night considered a success. Now imagine a slow Tuesday, half-full dining room. The same fixed costs, rent, salaried chefs, insurance, still apply in full. Revenue drops by half. Profit doesn't just shrink, it frequently disappears entirely, sometimes turning negative. This is the paradox at the heart of fine dining. The higher the price point, the smaller the margin for error. Debt and financing make this even more precarious. Opening a 5-star restaurant is enormously expensive before a single guest is ever served. Renovating a space to luxury standards, professional kitchen equipment, custom furniture, sound design, lighting design, and hiring a proven executive chef can push opening costs into the millions of dollars for a serious flagship location. Much of this is financed through loans, investor capital, or, in the case of celebrity chefs, backing from restaurant groups or hospitality investors who expect a return. This financing structure explains why so many acclaimed restaurants close despite critical success. A restaurant can win awards, receive glowing reviews, and still fail to generate enough consistent revenue to service its debt and cover its enormous fixed costs. Take the case of elBulli, once considered the best restaurant in the world under chef Ferran Adrià. Despite its global reputation and years-long waiting lists, the restaurant reportedly operated at a loss for years, subsidized by consulting work, book deals, and brand licensing rather than the restaurant itself. The prestige was real. The core dining room by itself wasn't consistently profitable. Compare that to a very different kind of success story. Nobu. Chef Nobu Matsuhisa, alongside actor Robert De Niro and restaurateur Meir Tieper, didn't just open one restaurant. They built Nobu into a global brand with dozens of locations, hotels, and licensing deals across multiple continents. The single restaurant model is fragile. The multi-location brand model, backed by hospitality real estate and licensing revenue, spreads risk across many revenue streams instead of relying on one dining room's nightly turnover. Here's an interesting industry fact most diners never consider. At many 5-star restaurants, the bar and wine program often generates a larger profit margin than the food itself. Wine, in particular, can carry markups far higher than food, sometimes 3 to 4 times wholesale cost, while requiring almost no additional labor once the bottle is opened. This is why sommeliers at top restaurants aren't just serving wine, they're quietly running one of the most profitable departments in the entire building. Private events and hidden revenue streams matter enormously too. Many 5-star restaurants only survive because of buyouts, private dinners, chef's table experiences, corporate events, and brand partnerships that operate on entirely different, far more profitable economics than a regular Tuesday night dinner service. A private event might guarantee revenue regardless of how many dishes are actually consumed, essentially transferring risk away from the restaurant and onto the client. Michelin stars themselves create a strange economic pressure. Winning a star can dramatically increase demand and prestige, sometimes overnight. But maintaining that star often requires increased staffing, more expensive ingredients, and constant reinvestment in the physical space. Costs that can outpace the additional revenue the star brings in. Some chefs have publicly discussed the immense financial pressure of maintaining Michelin standards, describing it less as a reward and more as a treadmill that never stops accelerating. Business failures in this space are common, even among celebrated names. Restaurants owned by famous chefs have closed after just a few years despite critical acclaim, undone by rising rents, thin margins, and the sheer difficulty of scaling an experience built around scarcity and exclusivity. The very qualities that make fine dining prestigious, small dining rooms, limited seatings, labor-intensive service are the same qualities that make it financially fragile. The future of this industry is shifting in response. Many high-end chefs are diversifying revenue deliberately, opening more casual, higher-volume concepts alongside their flagship restaurants, launching packaged food products, writing cookbooks, licensing their names to hotel groups, or moving into television and media. The flagship restaurant increasingly functions as a prestige engine, a brand-building showcase rather than the primary profit center itself. So is owning a 5-star restaurant actually worth it? The owners who succeed are rarely relying on the dining room alone. They build ecosystems, multiple locations, licensing deals, private events, retail products, and media presence that generate revenue independent of nightly covers. The ones who fail are often the ones who believed prestige alone guarantees profitability, chasing awards and reputation while ignoring the brutal mathematics of labor cost, rent, and razor-thin seatings per night. The next time you sit down at a five-star restaurant and see a menu with no prices, or prices that seem shockingly high, remember this: you're not just paying for dinner. You're funding an extraordinarily expensive, precisely engineered machine, one where a single slow month, a single supply shortage, or a single lost star can turn a celebrated dining room into a cautionary tale.